Life is full of risks. Some risks we're willing to take, like rock climbing. It's fun, exciting, and yes, dangerous. Meet Lucas. He knows the risks. If he falls, he could lose his life. But Lucas climbs anyway, because to him, the thrill is worth it. Now, Lucas can choose to take risks like that, but when it comes to his family's financial future, that's a risk he doesn't want to take. That's why he bought life insurance, to make sure his family is secure no matter what happens. But here's the big question. How much life insurance do you actually need? And once you know the number, what kind of policy should you choose? A simple, affordable one that just protects your family? Or a more advanced one that can also grow money for the future? Stick around because in this video we'll cover both. By the end, you'll know how to estimate the right amount of coverage and you'll understand how cash value life insurance works. Let's start with the basics. How much coverage should you get? The very first thing to think about is your family's needs. Life insurance is meant to replace what you provide. So if you weren't here tomorrow, what would your family need to keep living comfortably? A simple rule of thumb says you should buy coverage equal to 6 to 10 times your annual income. So if you earn $60,000 a year, you might need between $360,000 and $600,000 in coverage. There's also another way to look at it, the standard of living method. This one calculates how much your family needs to live on every year. Then, you multiply that by 20. The reason is simple. The insurance money isn't just spent all at once. It can be invested to create ongoing income. Here's an example. Imagine your family needs $50,000 a year to cover living expenses. Multiply that by 20 and you get $1 million. That $1 million payout could be invested, and even with modest returns, it could provide $50,000 every single year for your family. But income and expenses aren't the only things to consider. You also have to think about debts. Do you have a mortgage, car loans, credit card balances, student loans? If something happens to you, those debts don't just disappear. They could fall on your family, making a hard time even harder. That's why many people add enough coverage to wipe out all debts completely. Another key factor is income replacement. If you're the main provider, you'll want your death benefit to replace your salary for many years. And don't forget inflation. The cost of living rises every year. If you're planning for long-term protection, you want to build that into the number. At this point, you might be thinking, wow, I probably need a lot more coverage than I first thought. And you're probably right. But here's the good news. There are different types of policies to match different budgets and goals. Let's talk about the two main options, term life insurance and cash value life insurance. Term life is the simple option. Think of it like renting insurance. You choose how long you want coverage, 10 years, 20 years, maybe 30 years. If you pass away during that time, your family gets the death benefit. If you outlive the term, the coverage ends. The big advantage? It's affordable. A healthy 35-year-old might pay just $25 a month for $250,000 in coverage. That's less than a daily coffee. But once the term ends, the coverage stops. And if you renew later, the cost will be much higher because you're older. Now, cash value life insurance is different. It's permanent, which means it lasts your whole life as long as you pay the premiums. Part of what you pay goes toward the death benefit, and part goes into a special savings account inside the policy. That account grows over time. The growth is tax deferred, which means you don't pay taxes on it each year. And the best part, you can use it while you're alive. Need money for an emergency? Want to invest in a business or help your kids with college? You can borrow against the cash value, often at competitive rates, and you don't need a credit check. This is why it's called a living benefit. Your family still gets a death benefit when you pass away, but you also get to use some of the value while you're alive. Now, let's be clear. Cash value life insurance costs more. Remember our 35-year-old example? While term life might be $25 a month, a cash value policy for the same $250,000 could easily cost $200 to $300 a month. That's a big difference. So why would anyone pay so much more? Because with cash value, you're not just buying insurance. You're also building a financial asset that grows year after year. Here's a simple story. Meet Greg. Greg wanted lifelong protection. And also, like like the idea of building wealth on the side. He chose a cash value policy. Over the years, his premiums added up, but so did his cash value. By the time he was older, Greg had built up enough to borrow money for an investment property without ever going to the bank. And when Greg eventually passed away, his family still received a tax-free death benefit. Now, here's the catch. Insurance companies keep the cash value when you die. Your family only gets the death benefit. So if you had $200,000 in cash value and a $500,000 death benefit, your family would just get $500,000, not $700,000. That's why the cash value is really for you while you're alive, not for your beneficiaries. So which should you choose, term or cash value? If your budget is tight and your main goal is protection, term life is usually the best starting point. It gives you the coverage you need at a price you can afford. If you want lifelong protection and the idea of building a financial asset appeals to you, then cash value might make sense. But remember, it's a long-term commitment. You'll be paying higher premiums for many years, and the benefits grow slowly at first. So let's circle back. How much coverage do you need? And what kind of policy fits your situation? Here's the simple formula. Look at your debts, add in your income replacement needs, factor in inflation, and then decide if you just want protection or protection plus a growing asset. That's the choice between term and cash value. The bottom line is this: there's no one-size-fits-all answer. The right policy depends on your family, your goals, and your budget. But what matters most is making an informed choice. Don't just take the first thing an advisor offers. Do the math, understand the trade-offs, and choose the plan that truly protects your loved ones. If you like help running the numbers or comparing policies, visit emeraldwealthservices.com. You can book a free consultation, and we'll walk you through your options step by step. If you found this video helpful, be sure to like, comment, and subscribe for more simple and clear financial tips. Thanks for watching, and remember, protecting your family's future starts with making informed choices today.